Hello, everyone. I'm James Tarkenton, the Senior Portfolio Manager at Townsend Asset Management, and wanted to take a minute to give you an update through June 30th on our capital markets presentation from earlier in the year. Wanted to also let you know that this is something that Townsend is looking to do on a more regular basis, given our lack of ability to meet and the desire to keep everyone safe and in this time. So keep on the lookout for future emails on different webinars across multiple topics. We aren't necessarily going to do everything on the financial markets. Also request that if you have any specific ideas of things that you'd like to hear about, to please let us know, and we can include that in our rotation. But today we're talking about an update through June 30th for the capital markets. I am going to share my screen with you and can get this going. So here we go. So our first slide, this is the stock market performance since January 2016. And it has various events along that time frame showing you what was going on at the time of the stock market's performance. Began on December 31st, the S&P 500 closed at around 3231, and on June 30th closed at 3100. And as of today, it's about 3210. So we're essentially flat on the year, which can be expected after being up 30% in 2019. There's just that slight hiccup here in March and April with the realization of the coronavirus, the extent of its effect that you can see here in the graph. We actually declined about 32% and quickly rebounded 40% to end up where we are today. In fact, it only took 22 days to reach a bear market being defined as 20% below the most recent peak. Bull market being defined as 20% up from the most recent decline, or the bottom. And it only took 22 days to get into that bear market, the fastest ever. And just to give you some other stats, the average recovery to a new bull market is 645 days, with the shortest period that it occurred being 212, and the longest being 2,423. And just so you know, there's 252 trading days in a calendar year. So the shortest period that it took to recover to a new bull market, again, was 212 days, so almost a full year. And the average is 645 days, which is 2.5 years. Well, we recovered into what is defined as a new bull market in 12 days. So clearly a lot of volatility. That was a theme that I tried to get across at our seminar back in February, that we should be expecting increased levels of volatility. I just didn't expect it to come in 60 days. Next, I wanted to talk about what is referred to as the breadth of the market. Breadth and strength of the market is a much healthier market. That means more companies are participating. The market's performance is being spread among a wider group of companies, a wider group of sectors. And this graph is from 2015 and shows the performance of the quote-unquote FAANG stocks, that being Facebook, Amazon, Apple, Netflix, and Alphabet, which is the parent of Google, and that of the overall S&P 500. And you can see, with it being indexed to 100, that the FAANG stocks are up almost 300%, while the S&P 500 is up 50%. And it's been increasingly talked about the crowded trade, et cetera. But I think this most recent event with the coronavirus added a new level of secular growth to these specific names, with stay-at-home orders, people downloading, watching videos, streaming, time on Facebook, and obviously people not going to the stores and ordering more through online retail, that of Amazon specifically. So I think there's some support for the performance of these stocks here this year, and it gives explanation of why they have been leading the market. I just want to take a sec. And thinking of sectors and how these sectors have contributed or what they represent in the market. Back in 2016, the technology sector represented about 22% of the index, and today it's 28%. And more shocking, the communication services sector, which is somewhat new, but includes Facebook, Alphabet, and Netflix, was representing about 2.5% of the index, and now it represents 11% of the index. So the performance has clearly led to greater contributions to the index itself from just these two sectors. But there are opportunities in the market. Buying the market as a whole today probably is not the best thing to do from a risk standpoint. But if you roll up your sleeves and do some due diligence, you'll find that there are companies that meet the criteria that you're looking for: good companies, good management, and most importantly, a good price. Because other companies haven't participated. Let me wanted to show you something that we do here at Townsend. So every week I come in and I run somewhat of a screen, okay, and it spits out, we search the entire market of stocks, regardless of company, regardless of sector. And this is, a few pages front and back. And it's very broad. We aren't trying to cut companies out of this list, because we want to see them. And the metrics that we search on are, the price earnings ratio, free cash flow yield, which is the company has to be producing positive free cash flow, a return on invested capital, the size of the company, market cap, and return on equity. So it's very broad. At the time of the epidemic, near the bottoms, this report on a weekly basis was spitting out about 400 companies. This is our report for Monday, and there are 153 companies on here. And if we step back, what I was just talking about with the bear market being a 20% decline from your recent peak, 88 of these 153 companies on this screen are trading more than 20% below from their most recent highs. So this is the first step, and it's just one step of our idea generation process. This is the beginning of the process. This is just identifying companies that pass this screen. The next step is obviously to, what does the company do? How does it earn? What are their economics? What is its competitive advantages, et cetera? But just trying to give you an idea that even in a market that's come snap back from the bottoms, having 88 out of 153 companies that match a screen still trading in bear market territory should give you the idea that there are opportunities, if you take your time, do your due diligence, and define them correctly, to find companies to put in your portfolio at attractive prices. Now, of these 153 companies, are we doing work on every single one of them? The answer is no. We have pulled out about 5 that we are taking to the next step, and the next step is not the finish line. The next step is, creating and starting to build an investment thesis on each one of these and why we should own them. But the point being that even though the FAANG stocks have contributed a significant amount to the performance of the market so far, there's still opportunities to find great companies at great prices, even in this environment. So get back to the slideshow here. Work through the rest of these. Let me just make sure that I didn't skip. Okay. So we talked about the price. Next thing you need to talk about is valuation. And so here's the stock markets, the S&P 500 price earnings ratio, going back a ways. Also with some events to show you, to kind of give you explanation. And right now the market's PE is 21.9, arguably expensive. The tech bubble was 24.5. That being said, one of the other slides I was going to put in here was the earnings growth and the path. But to be frank, I just don't think it's very of any use right now. I mean, the earnings have just, 180 of the 500 S&P 500 companies have pulled their guidance for the year. Goldman Sachs reported 2 days ago, and all the smart people on Wall Street and all the analysts and everything expected Goldman Sachs to report about $4 in earnings, and the company, Goldman Sachs reported $6.26. So they reported over 50% more than what the market was expecting of them to report. So I think the earnings are all over the place right now. The E and the PE has very little value, in my opinion. So while it's 21.9, it's kind of it's a high number just because there is no E, or people are very pessimistic of the E. But I think what we're thinking about is, there has to be an expectation, given how the market has bounced back, that we are going to see a gradual improvement in corporate earnings heading out of 2020 and accelerating in 2021. And as long as that occurs, as long as we see that gradual path, then I think the market's at an appropriate place. Clearly, the market's looked through 2020. It doesn't care what the earnings are, or it wouldn't be trading here. So we'll just have to see and watch and make sure that economic recovery occurs along that path. I jokingly used the term a number of times during the seminar in February that the Townsend bumper sticker this year was volatility. And our seminar occurred after the first day of the sell-off from coronavirus. And so you got to see a little blip in this graph from when we started. And what this is a graph of the VIX index. And the VIX index is a measure of puts and calls, call options, that basically express the market's expectation for volatility. And while we've come down significantly from record highs in the 80s, 30.4 is still in the top 10% of this index historically. So clearly we should continue to expect some volatility, some good days and some bad days, because everybody's trying to figure out what's going on, and there's going to be a lot of headline news that will drive the markets on a day-to-day basis until we start to see some of the improvements and some of the expectations on maintaining this virus. Another way to think about volatility, we've shown this a number of times. This is the number of 5% pullbacks. So not just 5% up or down, purely 5% down in a calendar year that investors can expect, and or you should expect, given the reality of the number of 5% pullbacks in a calendar year. This goes back to 1980. You see that the average, the black line across all bars, is 4.6, so about 5% pullbacks a year. Here we are, the first half of the year, we've already had 10. So we're clearly on the higher end of that, and I would expect we're going to see a few more by the end of the year. But what's interesting and why people's anxieties have increased on the movements of the market is, if you look at 2012 and going forward, 2012 had 2, 2013 had 1. You can see there that 2017 had 0. Frankly, we've been spoiled. We've been playing in a market where people's expectations are that you shouldn't have any volatility, that the market just goes straight up, and it doesn't. So when it doesn't, and it hasn't in the past, or you haven't had this in the past, you have no expectation for there to be movements up and down, or at least not at the frequency and severity with which they're occurring recently. But if you build a portfolio of good quality companies and you hold those companies, as long as they're building and growing their franchise value, then you will do better than others who are simply just investing in the market. And so that's what we're trying to do here at Townsend. And we're trying to not capture as much downside as you would if you blindly were just investing in the market. So This is an attempt to express the idea that no one has the ability to time the market. This is a representation of $1,000 being invested over the last 25 years, and the results you would receive if you exited the market after just a 2% move or worse, 2% or worse. So we just showed that there've already been 5% downturns this year, this calendar year. This is showing if you decide after a 2% decline to exit, and the blue bars, this is the length of time for you to get back into the market. And I just think it's completely telling, and hopefully it's illustrative that if you did nothing at all over the last 25 years, and that includes the 2008 financial crisis, that includes the dot-com bust, that includes all the currency concerns and global currency devaluations that occurred, very stressful times, the 9/11 terrorist attacks. If you did nothing, you had close to $4,900. If you took the money out after a 2% drop in any one of those environments and took 1 month to get back in, your $4,900 becomes $1,700. So again, it's an attempt to express to you that the idea of building high quality portfolios should be able to sustain better and grow longer, and frankly, investing with emotion, or the idea that activity is smart for purely activity's sake, it's going to have a drastic effect on your performance. Here we've got GDP going back quite a ways, even before 1970. Each one of these blue bars is a quarterly read on GDP. You see that in the first quarter of 2020, we were down 5. The powers that be have already announced that we are in a recession, if it wasn't clear to anybody before that announcement. Expectations are that second quarter GDP will be way worse. But similar to the price earnings multiple, and what we're watching is this gradual increase in economic or corporate earnings, the expectation is that we will exit this year, 2020, in a positive position, not for the full year, just exiting the year. We'll have positive GDP growth, and that growth will accelerate through 2021 for a positive GDP reading for the whole year of 2021, with each quarter being positive. We have to continue to follow and make sure that's the case. But I think it's also interesting on this slide for you to see that over time, as we've come through time, the level of GDP growth needed to sustain attractive market returns has come down, through that time frame, to where the most recent business or most recent growth, was sustained with just 2.2% growth. So that's what we're watching. That's what we did, and that's what we think the market is expecting. And as usual, if something else happens, the market's going to react. Just wanted to show the Treasury yield curve. The yellow line is a year ago. The what I'll call orange line is 1 quarter ago, and then the blue line is as of today. We have the 1 year ago, we were in what was called the inverted yield curve, which has historically been a prognosticator of recessions. It's usually for financial reasons. This was not forecasting the coronavirus by any means. But you can see that we're now, in a proper upward sloping yield curve. That being said, these rates are at historical lows, driven by a very accommodative Fed trying to stimulate and support the economy through liquidity. I think it's also important to realize, or an interesting fact, that 80% of the S&P 500 80% of the companies in the S&P 500 have yields greater than government bond interest rates. So that kind of explains that, fixed income investors are looking at, if you're going for income, a lot of that fixed income allocation is coming over to equities to generate or achieve that income. Here are U.S. corporate bond yields from across the credit spectrum, from AAA to CCC, CCC being junk. And you can see that even with a double B corporate bond, which is a non-investment grade bond, you drop out of investment grade after triple B, that is a 5% rate. You could argue that, well, that's traditionally what's been a triple A rate. But interest rates have come down for sure. And so that has affected yields in the fixed income market. And so bond investors basically trying to weigh the risk in equities that they're taking to get income versus the credit risk they're taking to get appropriate level of income. And I would argue that the credit risk to get what has traditionally been an attractive yield in the fixed income markets sends you so far out on the credit spectrum that you're taking way too much risk for the level of income that you could earn in the fixed income market right now. Just a picture of the global central bank balance sheets, both the US Fed, the Bank of Japan, and the ECB. These are spiking because globally there is financial stimulus and liquidity to support the global economic environment. Just to give you a sense of the size of the stimulus that's been created this year, back in 2008 from the financial crisis in the United States, there was $1.5 trillion in stimulus. That was, you'll remember, saving AIG, saving the auto car manufacturers, saving the airlines, et cetera, $1.5 trillion. Well, so far to date, and I say so far because I do believe there'll be further stimulus here in the back half of the year, we are at 3.3 trillion alone. So more than double what the 2008 financial stimulus has been. Just briefly on global markets, this is a graph showing a performance indexed to 100 over the last 2 years. So that's why it's nice to maybe step away from current environment and think that over a 2-year period the U.S. market is up over 14%. But the point here being that the U.S. has clearly outperformed both developed market and emerging markets, and where we're finding opportunities to do so here at Townsend with our clients, and as long as it's client specifically appropriate, we are allocating to developed and emerging market opportunities when we find them, because not only is the price attractive, but there's 2 aspects to every decision, but driven by price and valuation. The valuations are more attractive than in the US, looking at just purely PE multiples. And so that's, again, where we can. We're not only finding, I've talked about you're still being able to find opportunities here in the US. It's harder, but you can. But also that the developed and emerging markets have become more attractive in this environment as well. I want to spend a minute on the elections. I know it's a topic on a lot of your minds. This shows the S&P 500's average return in election years. So this is not when whoever gets elected going forward. This is purely a year in which there's there's elections every year, but it shows different type of or most years there's elections. So the green bar is when there is not an election. The blue bar is when it's a presidential election, and the yellowish brown bar is midterm elections. And I think there are a few points here that, and on the right side, it excludes 2002 and 2008. But the important thing here is just to recognize that not only are all these bars positive, the performance positive, but they're all double digit. There's been 22 elections since the S&P 500 was created, and in presidential years, when a Republican was elected, the average return is 15.6. When a Democrat is elected, it is 7.6. In all election years, it's 11.25. So just want to make the point that if you are making significant and drastic changes to your portfolio based on a presidential election, this is just evidence that, it's just, you're only hurting yourself. There's no reason for it. This graph is from 1933. I'm very certain there are a number of contentious elections in this data. but still shows double-digit returns in presidential election years. And in fact, if you remove 2008, which I don't think is fair, because that was purely the financial crisis, and the market was down 37%. That means 18 out of 21 years the market's positive, or 86% of the time. And the 3 years where it wasn't, the worst down year was 9%. So if that holds any weight, the argument would be you're going to risk positive returns to protect a potential 9% downturn. Their politics and our government requires multiple participants. Candidates promise the world getting elected, and once in office, they change their agenda, or the scale of which the agenda, or where those agenda points rank as far as an attempt to get things done, is always fluctuating. So I think the best bet probably is just to sit still if you're making changes to your portfolio purely from an election standpoint. Another data point I'm going to just quickly show you. This is growth of $10,000 from 1961 to 2019. And it's not important that you see what these numbers are, I'll tell you, but basically right here, this red bar, which would mean if you invested only when there was a Republican president. The blue bar, the small blue bar, would be if you invested only with a Democratic president. And this gigantic bar is if you invested along all presidents. So $10,000 in investing with only a Republican president would get you $86,000 from 1961 to 2019. Investing only with a Democrat gets you $376,000 over that time frame. And ironically, staying invested in all periods and all presidents, that $10,000 turns into $3.2 million. So I guess my point is, again, if you're making portfolio decisions based solely on an election, I think you're making a mistake. And we can wrap up here with just one more screen. Wanted to basically show you where we are across various different markets and asset classes, sectors, etc. So where do we go from here? I think on the positive side, we clearly have an accommodative Fed. The Fed president has basically said we're going to do whatever it takes. So that is obviously going to support asset prices going forward. And I think as each day we move forward, we're getting closer and closer and getting more and more clarity on not only the success of vaccines, but also the timing of when those could be administered. And the market doesn't wait for the day the first shots start getting put to use. The market moves on the anticipation of things. Maybe I'm an optimist, but I do feel that the amount of time and money being spent on trying to find a vaccine for this virus is, I'm pretty sure, like nothing else we've ever seen before. I do think that as we start to exit this calendar year, we will have a much clearer picture on not only that there will be a virus, but the timing of it. And if that occurs, you will see the market continue to improve and improve dramatically. The labor market will improve dramatically. And that will be very supportive to asset prices. Now, obviously, the things we need to be concerned about is a second wave, which will obviously change the trajectory of the growth rate in both corporate earnings and the economy that the market is expecting right now. And if that were to occur, we would definitely have another downdraft in the market. And so here, Townsend, as I tried to explain with that the explanation of the screen, we're looking at the unloved. And we're going to find some great opportunities in this market. You still can. And so hopefully this has been helpful. If you view this and have any questions, don't hesitate to give us a ring. And happy to go into greater detail. And please look out for future announcements of future webinars so that we can stay in touch. Please, everyone, which I hope you already are, safe and well. to continue to be so. And we'll talk to you soon. Thanks so much.